Valens Research, Uniform Financial Analytics.
And so the first chart that you come to when you look at Salesforce.com is this specific chart. And what this is our performance and valuation prime chart. And what I'm going to do here is I'm actually going to turn on the distorted as reported accounting metrics so you can see just how distorted the as reported accounting is for this company. And right, you can see Salesforce, this is a huge business, right? Salesforce is a $170 billion company. And yet even for a company like that, people misunderstand the real returns of this business when they're looking at as reported accounting. So why do we start our clients with the performance and valuation prime chart? Because as the name says, performance and valuation prime, it really tells a complete picture of what a company's actual performance is, what their returns are, and their asset growth is, and also what valuations are, right, in terms of VE and VA. VA is our adjusted price to book metric. VE is our adjusted price to earnings metric. You can see first, these orange bars are the distorted as reported return on assets for Salesforce over the last 15 years. These blue bars are what the true uniform accounting returns are for Salesforce after we make all the key adjustments we need to make for Salesforce for things like R&D capitalization, operating versus excess cash, stock option expense, just to name a few. These two light blue bars are what the sell side analysts are forecasting Salesforce to do in 2020 and 2021 once we take sell side estimates from Goldman Sachs, Credit Suisse, JP Morgan, etc., and we adjust them into the uniform accounting standard. And last but not least, the white bars here are what the market is pricing in right now. At a market cap of $170 billion for Salesforce, this company needs to see returns expand from 27% in 2020 all the way up to 51%, basically doubling for this company to be fairly valued. The way you can think about this, if you're familiar with sports betting, is think of this as the line, right? If you will, so we're based in Boston. I may not be a Pats fan, but for the Patriots, for instance, right, the Patriots might be favored against a team like, let's say, the Jets by 10 points. Right, that means that the Patriots need to beat the Jets by 10 points for you to be able to win your bet. If the Patriots win, but they only win by points against the Jets, you lose your bet. It doesn't matter that the Patriots win. Just like for Salesforce, it doesn't matter if Salesforce's returns are improving. What matters is if Salesforce returns can improve more than the market's pricing in right here for Salesforce. Right, what we can see what jumps out with Salesforce is this company, if we look, the as reported accounting misrepresents how strong the returns are for this business, right? This business isn't a 1% ROA business. It's a 28% return business. But that's just one part of what we're looking at here. The other part is seeing, hey, when we clean up the noise and look at the uniform accounting metrics, we can see Salesforce's returns, their return on assets, has been remarkably flat for the last 10 years or so, really since 2006. It's almost always hovered around 25%. That's forecasted to continue the next 2 years, but the market is pricing returns to double, right? That's very aggressive. That makes Salesforce look kind of expensive. And similarly, if we look at asset growth, right, previously Salesforce was able to grow year in, year out because Salesforce was able to basically massively scale their business. But over the last couple of years, what you can see is, well, as reported metrics make it look like Salesforce has still been growing gangbusters, has still been growing massively. The reality is Salesforce has actually been growing a lot slower, right? What the market's probably looking at for sales growth is they're saying, oh, 37, 25, 39. Salesforce can still grow at 40% a year. And if they think that Salesforce is growing at 40% a year, they're pricing Salesforce for returns to be flat, right? If you remember, we talked about how this is the line. If the company can exceed this return, it's undervalued. But it also is in the context of this growth. The company would need to have 40% growth a year, meaning they would have to double every 1.5 years or so, and also have returns be flat to be fairly valued. In reality, Salesforce has grown more than 15%, 10% one time in the last 4 years, which that highlights to us why it looks like the market, because it's misunderstanding the returns, but more importantly, misunderstanding the growth for Salesforce is misunderstanding Salesforce in reality. If we say, hey, you know what, we think Salesforce is probably going to be able to grow at 10% a year going forward, which is basically what they have done the last couple of years. And we also think that just like they have, returns are going to stay flat, right? We can do a quick scenario analysis here using what we call the embedded expectation tool. And we can say for our output, what does this mean Salesforce's worth? If Salesforce did just this, Salesforce wouldn't be worth $190 a share. Salesforce would be worth $73 a share, right? That means you wouldn't see a $170 billion market cap firm. You would see around a $65 billion market cap firm. That's how expensive and how high expectations are for Salesforce. The thing is, though, you wouldn't realize that if you were looking at the as reported numbers, because you would see high growth and you would see returns that are improving from basically 3 years ago at 0.5% to 1.3%. You say, hey, you know what? Even though returns are low, they've basically tripled and the company's growing. In reality, returns have been flat and growth has been slowing, and that's going to disappoint the market.
Valens Research, the world's leading source for uniform financial analytics.